Hey everyone, welcome back to today's episode. Look, every day someone's screaming that Australia's property market is in a bubble that's about to burst. But here's what they're actually missing. The data tells us a completely different story. Today, we're breaking down whether Australia is actually in a bubble, what would actually trigger a crash, and why the real story is far more nuanced than the headline suggests. We'll also expose one metric that actually predicts property crashes. And spoiler alert, it's the opposite of what's happening in Australia right now. Later, you'll discover why previous property crashes happened in other countries, but won't happen here in the same way. So, again, welcome back to the channel where we'll separate property myth from market reality using data instead of fear. Today's topic is one of the most misunderstood in Australian investing. Is Australia in a housing bubble and will it burst? And here's why it matters. If you believe we're in a bubble, you might sell or avoid property entirely and miss wealth building opportunities. If you don't believe we're in a bubble, but prices crash anyway, your equity evaporates. Getting this right could mean hundreds, thousands of dollars. So today, I'm going to give you the actual definition of a property bubble, show you the data that reveals what's really happening in Australia's market, and then give you the frameworks to understand whether a crash is coming or whether we're in something entirely different. This isn't hyper opinion, it's data and structure. So let's dive in. All right, first, let's define what we mean by a housing bubble, because most people get this wrong. A true property bubble has specific characteristics. Number one, the prices rise dramatically higher than historical norms relative to incomes. Number two, this rise is driven by speculation, not by fundamental demand drivers. Three, access to credit becomes easy and loose. Lenders are relaxed, interest rates are low, and borrowing standards are weak. And finally, four, when the bubble pops, prices crash sharply because buyers exit simultaneously. So we look in the 2007 US housing crisis. This is a textbook example. Median home prices rose from $200,000 to $350,000 in 5 years. Lending standards collapsed. No-doc loans, negative amortization, cash-out refinancing was rampant. Everyone could get a mortgage. Speculation was rife. And when rates rose and adjustable mortgages reset, borrowers couldn't pay. Foreclosures exploded, which resulted in prices collapsing from $350,000 to $180,000, a 50% crash. Now that's a bubble. Now let's look at Australia's current situation against each of the different criteria I mentioned before. So let's tackle the elephant in the room, number one, right? So yes, Australia's housing is extremely unaffordable right now. There's no denying that. The median price to income ratio has almost doubled. Back in September 2001, the ratio was just 4.4 times median income. Today, it's 8.6 times, a near doubling. Looking at Sydney specifically, 13.8 times the median income. That makes Sydney the world's second least affordable city, just after Hong Kong. So for context, affordable housing should be 3.0 times the income or less. At 5.1 to 8.9, Australia's cities are considered severely unaffordable. Above 9 points is impossibly unaffordable. So Sydney, Melbourne, Adelaide, all in the impossibly unaffordable brackets. So far, this looks like bubble territory, right? So here's the critical distinction that most miss. Unaffordability alone doesn't mean a bubble. It means there's a structural mismatch between incomes and the prices. But that's not the same as unsustainable speculation. Australia's price to income ratio is elevated because of three structural factors, right? So number one, population growth and inbound migration. Australia's population grew by 423,000 in the year to June 2024. Strong immigration maintains demand, right? Number two, chronic housing supply. AMP estimates a shortfall of 200,000 to 300,000 homes for Australia's existing population. Supply just can't keep up with the demand that we need. And number 3, deliberately restricted lending standards post-GFC, global financial crisis. Australian banks underwent complete reforms. Mortgage serviceability requirements are stricter than the US. The average new mortgage now requires 15.7% of income for a median house. But that's because median incomes are just $101,000 and median house prices are $807,000. Compare this to the US before the GFC, where you could get a no-doc loan with 5% down and 40-year amortization. Australia's lending standards are the complete opposite. Most new mortgages require a 20% deposit and a 30-year amortization, with serviceability stress tested at 7.5% interest rates. So what's the result of this? Prices are high, but the market isn't fueled by loose lending or speculation. It's fueled by undersupply meeting strong structural demand. So here's the first critical indicator that this isn't a bubble. Lending standards are tight, but they're not loose. In the US before the GFC, you could get a loan with 0 down payment, right? i.e. ninja loans, no income, no job, or even assets. No documentation, negative amortization, meaning payments didn't even cover the interest, and adjustable rates that reset after 2 years. So today in Australia, it's the complete opposite, right? Most borrowers require 20% down or mortgage insurance, which is expensive. Full documentation is required, income verified, employment checked, bank statements reviewed. 30-year fixed mortgages with stress testing at 7.5% interest, and responsible lending laws prohibit unsuitable lending. So the result of this is Australian mortgage arrears sits at around 1%, which is historically low. If we were in a bubble fueled by loose lending, arrears would be absolutely spiky, but they're not. So if a property crash happened tomorrow, Australian borrowers could actually pay their mortgages because lending standards prevented people from borrowing beyond their capacity. That's bubble prevention architecture. So let's examine what's actually driving Australia's price growth right now. Is it speculation or is it fundamentals? All the data point to fundamentals. Population growth. Australia's population grew by 423,000 people in 2023 to 2024. Over the next decade, population is expected to grow by 4.1 million more people. Where do 4 million people live? They need houses, they need dwellings. In a constrained supply environment, demand exceeds supply and prices rise. This isn't speculation, it's demographic necessity. Then we look at immigration. Australia's been attracting skilled migrants, particularly from India, China, the UK. Net overseas migration contributed significantly to the population growth. These aren't speculators, they're people relocating their lives permanently and needing permanent housing. Then there's employment. The economy is creating jobs. Over the next decade, 2.8 million new jobs are expected. People with jobs buy houses. They're not speculating, they're settling, building families, and establishing lives. Then we look into the rental market, which is very tight right now. Vacancy rates across Australia are at historical low levels, 1.2% nationally. This creates investor demand. Investors aren't buying for quick flips. They're buying for 25-year loan terms, targeting yield and long-term equity. That's the opposite of speculation. And rents are forecast to rise even further. They're expected to rise by almost 24% between 2025 and 2030. With 92% of 2-bedroom apartments exceeding $700 per week. If rents rise that much, investment fundamentals support higher prices. It's not a bubble, it's a repricing. So let's compare this to the GFC in the US, right? The US crash happened because demand evaporated. Prices had decoupled from incomes so severely that when lending standards tightened and rates rose, buyers simply exited. Supply flooded the market, and that's what happened when prices crashed. In Australia, right now, none of these conditions exist. Demand is structural, it's not speculative. So here's what's driving price growth right now, okay? Interest rate cuts. The RBA has cut rates 3 times in 2025. Each cut increases borrowing capacity and buyer confidence. Economics 101. Lower the rates, they equal higher prices, assuming supply stays constrained, which it is. So forecasts show that another 2 to 3 rate cuts possibly coming through late 2025 through to end of 2026. These cuts will provide further upside for prices. Then we look into first home buyer support. The government expanded its first home buyer assistance, removing income caps and raising price thresholds. This injects new demand into the market. Not to mention, as mentioned before, the supply constraints. Building approvals are running at very low levels. New construction can't keep pace with population inflow and household formation. This undersupply is forecast to persist all the way through 2026. So what's the result of this? Multiple forecasters expect continued price growth. ANZ expects 5.0% growth in 2025 and 5.8% in 2026. CBA, 6% in 2025 and 4% in 2026. HSBC, 4.9% in 2026. Sydney specifically is forecasted to reach a median of $2 million by the end of 2026. And Melbourne is about to break the $1 million mark. So now here's the critical question. What would stop this? What would cause a crash? Right? A crash requires one of four things. Right? So number one, demand destruction. So recessions, mass unemployment, geopolitical shock. Two, sudden tightening of lending standards beyond the current levels. Three, a shock increase in interest rates far above historical norms. Four, a flood of new supply suppressing prices. So let's quickly assess each. So the first, demand destruction. Unemployment is low at around 3.5%. The economy is growing. Geopolitical risks exist, but they aren't triggering immediate recession. This is unlikely in the actual near term. Then we look into lender tightening. Lending standards are already tight. There's limited room to tighten further without creating an absolute credit crunch. So this is also unlikely. Rates increase. The RBA is cutting right now. They're not raising. Rates are headed down, not up. This is the opposite of a crash trigger. And then supply flooding. New construction is actually slowing, not accelerating right now. Government promises of 100,000 new homes take years to deliver. Supply won't flood the market. So what's the conclusion here? The structural conditions for a property crash simply aren't present. You need either unemployment rates to spike to 10% plus, rates to jump to 5% plus, right? A massive supply shock in the market. None of these are forecasts, and they're not building it in the data. So look, here's the insight that most people miss. Australia isn't in a bubble. Australia is in an affordability crisis, and they're different things. A bubble is temporary, it pops, prices crash. An affordability crisis, it's structural. It persists until policy or market dynamics change. Prices don't crash, they stagnate or grow slower than incomes until a new equilibrium is reached. So Australia's situation right now, prices have risen faster than incomes for decades. The gap has widened dramatically during the pandemic. This created an affordability crisis. Many Australians can no longer afford to buy. But this doesn't cause crashes, it causes stagnation. So how does an affordability crisis resolve? So option one, policy intervention. Government builds massive supply. Prices stagnate, incomes catch up, equilibrium is reached. Option two, migration slows. Demand moderates, supply catches up, and prices stagnate. Option three, wage growth accelerates faster than price growth, which narrows the gap. And option four, the current dynamic persists, prices remain high, affordability stays stressed, and wealth inequality widens. First home buyers exit the market, becoming investors instead, as they are right now. Australia is evolving towards option four right now. First-time occupiers now represent just 25% of the market, which is down from 40% pre-pandemic. Investors are capturing more demand. This is a crisis for housing access, not for property investors. Prices won't crash, they'll simply grow slower than investors' expectations. And affordability will remain stressed, probably for another decade or so. So, is Australia in a housing bubble? No. Will it burst? Not in the traditional sense of the word, right? But what does this mean for your investing strategy? So first, stop waiting for a crash. The structural conditions for a crash aren't present, and the data doesn't support the narrative. You'll miss 5 years of wealth building waiting for something that's unlikely to happen. Second, understand that affordability will remain stressed. Prices will continue to grow. but at moderated rates as rates stabilize. Double-digit growth is unlikely after 2026, however. Mid-single-digit growth is more realistic through the late 20s. Third, focus on suburbs with genuine supply and demand imbalances. Not all suburbs perform equally, okay? Growth corridors with population influx and undersupply will outperform. Oversupply precincts will stagnate. Fourth, cash flow matters now. In an environment of slower price growth, rental yields become critical to returns. Target properties with 4% plus yields, not speculative plays betting on 5-year doubles. This is the new investment reality in Australia. Slower price growth, more focus on fundamentals, regional outperformance, and cash flow optimization. So look, if this data-driven analysis value, please hit the like and subscribe. Drop a comment below. Do you believe Australia is in a bubble? Or do you see it differently? I read every comment and respond to the most thoughtful ones. So please put it down below. This is how we separate investing wisdom from investing mythology, by following data instead of fear. And if you're ready to build a property strategy aligned with what's actually happening, not what the headlines claim, join our exclusive members group, where we provide quarterly market updates, suburb by suburb forecasts, and strategic guidance tailored to actual market conditions, not bubble hysteria. We'll help you understand which suburbs are positioned for genuine growth, which rental markets offer real yield, and how to navigate Australia's affordability crisis as an investor. Book your call today, and let's build your strategy on data, not noise. Thank you.